So it's getting from bad to worse. The German economy is crashing further, and this decline can't seem to stop. And this is a case study of what happens when you lose the beating heart of your economy, which is cheap energy. We saw this crisis a mile away, guys, and Germany's economy is on the brink of long term stagnation. And in our lead story today, Germany predicted to be the only major European economy to contract this year as recession lingers. And there's a reason why even the IFO Institute is calling Germany the sick man of Europe. It's because this decline is structural and there isn't any reverse button. Europe's largest economy is predicted to contract by 0.4% this year. This means the recession is going to continue possibly well into 2024. When you lose your biggest leverage, which is cheap energy, everything else crumbles into dust. And how long can Germany sustain this burn? Because neither Saudi Arabia nor Russia is going to increase production to lower gas prices for Olaf Scholz. Sure, Germany has an ambitious plan to increase their renewable energy mix from 47% today to 80% by 2030. They want the majority of their energy to be generated from wind and solar power, but this ignores the fact that the immediate crisis they are facing is one of fossil fuels, of gas power. And what happens from now all the way until 2030? And that is assuming everything goes smoothly during this transition. Companies are starting to move away from German soil, and winter is coming, guys. Yes, we all seem to forget Ned Stark's warning. The White Walkers are coming. During the winter in 2022, households and industries cut back on their energy consumption. While that helped to prevent a shortage of gas, prices were still sky high, and German industry took a big hit. It triggered a landslide contraction, which we are now seeing in real time. And if winter gets colder, and if Putin decides to ramp up the pain with more production cuts, Germany and the EU will all suffer. And this is a horrible dilemma to be in because all the critical inputs in Germany are out of their control. In the Bloomberg survey of economists, they are forecasting Germany's GDP to recover by 2024, hovering around 0.4% growth. But those are very optimistic projections that don't really factor in higher energy prices and a slowing global economy. Germany is highly dependent on manufacturing exports to grow, but now both the supply and the demand side of the equation are compromised, and this pain is just going to continue. In a report by the Financial Times, Germany's industrial gloom is getting worse as production falls, and this is dragging the Eurozone deeper into recession, with Q2 growth revised down to 0.1%. The once proud German auto industry is driving this drop. Made in Germany is about to be replaced by Made in China very soon. And it's not a question of quality, but a question of manufacturing costs. German cars might be of higher quality, but it doesn't matter when the whole world is broke, and price really does matter. And here's how bad things are. Production in Germany's car making sector fell 9%, and that is a humongous drop that can't be ignored. In fact, car makers are getting help outside of Germany to produce their own cars. I kid you not, guys. It's tragic and really shows you the state of manufacturing in Europe. According to Bloomberg, the German car maker BMW is getting help from China to produce electric Mini Coopers. They are relying on China's Great Wall Motor Company to produce their cars for import into Europe. So cars are being made in China for the BMW brand and then shipped to Europe. And this means even after all the hassle, even after all the export costs, it is still cheaper to manufacture out of Germany. Sure, a big factor is tapping to China's EV advantage. China's EV tech is more advanced than Europe, but that is just one small factor. The key difference is all about energy costs. Manufacturing in Germany is just too expensive. Researchers have found that the average price of an EV in China was less than 32,000 euros, but in Europe, this was around 56,000 euros. That is a 25% difference because manufacturing in China is simply cheaper. Auto supplier Forvia has also confirmed that Chinese automakers can make EVs cheaper. Compared to Europe, China can produce it for 10,000 euros cheaper, which is why we are seeing BMW produce their Mini Coopers there. It's not rocket science, it's all about unique economics. And in this chart, we can see how higher energy costs have crippled Germany's industries. Compared to services, the energy-intensive industrials have collapsed. Production is down almost 20% from the 2015 baseline, which is a big problem. The moment Germany was decoupled from cheap Russian gas, this crisis became inevitable. Energy is an input cost that directly affects the selling price. We are now in a world where the extra thousand or two on the price tag is enough to turn off consumers. Everyone is price sensitive today. Guys, even at the supermarket, I'm on the brink of going for house brands. Just imagine that, house brands, to save an extra 10, 20, or even 30%. Manufacturing is the beating heart of the German economy, and if that collapses, the rest of the economy would fall into recession. Compared to the rest of the G7 nations, Germany's dependence on industry is big. It accounts for nearly 27% of economic output and is only matched by Japan at 29%. The United States and France are more service sector oriented, so higher energy prices might be bad, it might be hard, but not exactly crippling. And in a shocking update, German factory orders slumped most since lockdowns in 2020. The July drop was worse than predicted by any economist. And we aren't talking about a 5 or 6% drop, which is bad enough. We are talking about a double digit crash. People were forecasting a moderate contraction of 4.3%, but Germany is now facing an 11.7% crash in factory orders. Consumption is crashing because price matters. If China's own factories are struggling today, it's no surprise that German orders are collapsing under the weight of higher energy costs. And it doesn't take a genius to see where this will lead to. Massive job losses in manufacturing and companies relocating away to other countries, and that in turn triggers even more job losses on German soil. We have the head of the German Industry Federation, the BDI, giving a dire warning. They are sounding the alarm bells, warning that German energy prices are so high, they are driving companies to relocate. And when asked about the current energy situation, here's what the BDI president had to say. Many Germany headquartered businesses are doing well globally, but they are struggling with operations in their own country. And this tells us the headspace of companies in Germany. And let's focus on China a bit now, because even though there's all this talk of decoupling, German companies are actually moving there. And it's not because they love China, it's just pure economics and necessity. Check this out, guys. Volkswagen is investing $1 billion in China to access its EV market. Even as Olaf Scholz is calling for de-risking, the private sector is saying no, we can't do it. And this new business center will be launching in 2024 and will create more than 2,000 jobs. It's mainly R&D for now, but the center will cover the actual production and manufacturing of cars down the road. So this energy crisis is real, and the longer it drags on, more companies could relocate abroad. Some will head to China for cheaper manufacturing, others will head to the United States for generous subsidies. And it's all about lowering production costs however you can, but the end result is still the same, a hollowing out of the German industry. And this macroeconomic environment is getting from bad to worse. We have never been in a situation where there are multiple storms converging together. Inflation is still a crisis, and that is forcing central banks to hike interest rates. However, we are also facing a global consumption crash where buyers are scaling back on everything, right? Higher rates will crush consumers even more. But the ECB is trapped and interest rates will likely go higher. Christine Lagarde, the head of the ECB, has vowed to keep interest rates higher for longer to slay the inflation beast. ING Bank has also released its base case scenario for the rate hikes going forward. They believe there's at least one more hike of 25 basis points coming. But in reality, there are probably a few more because inflation is still the monster in the room. To really fight higher prices, you need to raise rates above the benchmark rate. The ECB rate is currently at 3.75%, but that is a far cry from where we need it to be. If we compare the current inflation rates in both the Eurozone and Germany, we begin to see a very big problem. August inflation for the Eurozone comes in at 5.3%. Germany's numbers are even worse, clocking in at 6.1%, but both inflation numbers are far higher than the ECB's benchmark interest rate. There's this big disparity between 5.3% and 3.75%, which tells us that more rate hikes are likely to come. You need to incentivize people to save more and to spend less. And to accomplish that, interest rates have to go above inflation at the very least. There's absolutely no room for either the ECB or the Bundesbank to inject stimulus to save the economy, right? Even the Federal Reserve doesn't dare to do it. Olaf Scholz himself is rejecting the idea of any fresh stimulus to boost the economy. And listen to this. I set no store by a debt finance flash in the pan so-called stimulus program that would counteract the European Central Bank's attempt to fight inflation. Back in July, the economy minister Habeck warned that Germany faces 5 tough years. And if the government doesn't approve fresh subsidies, there is a big risk of German industries leaving the country, which is what we are seeing now. The country's industrial base could shrink. So you can see the quandary that Germany is trapped in. But it's not going to be easy, and it's going to get worse because it's not just about securing your energy supply, guys, but buying it at a good price. And guess who's in total control of the global energy markets? OPEC Plus, specifically Russia and Saudi Arabia. They have regained control and they are now behind the wheel. The problem Europe has is still a credible dependence on Russian gas today. While it is true that piped natural gas has gone dramatically down, the Eurozone is now hooked on Russian LNG. Even after all the sanctions, the EU is importing a crazy amount of Russian LNG, hitting over 1.2 million tons in May this year. We can see the reliance has increased from the pre-war levels. Europe is importing Russian LNG like never before because they simply need the energy. According to Reuters, this dependency has actually grown. In the first 7 months of the year, EU countries imported 40% more LNG from Russia than 2 years ago. And this means Putin can always turn off the gas taps this winter and ramp up the inflation pain. And this will come at a time when German industries are on their knees. And there's a real possibility that this might happen. If Russia cuts away the gas supply, we can expect another surge in inflation that Germany isn't prepared for. Even if they don't import Russian energy directly, cutting supply will increase the global price of LNG for Europe. Even the IEA is afraid that Europe might not survive this coming winter. They have issued a deadly warning to the EU that this energy crisis is far from over. A cold winter, together with a full halt of Russian pipe gas supplies to the European Union starting from 1st October 2023, could easily renew price volatility and market tensions. So we have two factors on our hands. Russia could very well halt gas supplies again this coming October to the EU. They have done it before and they could always do it again. Then we have the possibility of a colder winter, and this is something that no one can predict. But if these two things happen together, right, we could see another energy crisis happen. Now, this wouldn't be an issue if Germany had a backup plan, but guess what? They have shut down all of their nuclear power plants. On April 15, Germany ceased to produce any more electricity from their nuclear plants. At its peak, nuclear energy generated 25% of Germany's energy. Essentially, they have crippled themselves. They cut away any alternatives. And even Greta Thunberg says it is a mistake for Germany to abandon nuclear power. And I hate to say that I agree with her. The Germans are simply piling on more dependency on natural gas. And this time, it's LNG. We are witnessing mistake after mistake. Germany's recession is going to be deeper and last for longer. And there's really no easy way out for Germany this time. The deck is truly stacked against them. But it gets worse. Instead of closing ranks with its biggest trading partner, which is China, Germany is moving to decouple further from Beijing. They are moving to tighten foreign investments from China, and any future capital coming from China will be scrutinized and approval will be harder. In addition, Germany is making it much harder for private companies to invest in China, and they are doing this by removing government guarantees for investments in China. In a government document, we get to see the full extent of these investment curbs. The volume of investment guarantees provided by the German government to companies investing in China has collapsed this year. And without investment guarantees, companies investing in China will not be protected from any political risks such as government confiscation. And so far, only 52 million euros in guarantees have been issued this year, and that's less than 10% of investment guarantees issued by Berlin last year. This puts up more roadblocks for companies looking to move their production to China. But here's the funny thing, not all EU countries are following Germany's playbook. France, in particular, is moving closer to China. The French finance minister is pushing for more investment and trade from China. He wants Chinese money to pour into French industries, especially in electric vehicles. He knows that decoupling is an illusion. If Germany decides to pull away from China, France is just going to swoop in and steal market share from them. 5 or 10 years from now, the situation in Europe could be very different. We will likely see a reshuffle of economic powers, and if this continues, Germany might actually lose the top spot as Europe's biggest economy. But let me know what you think in the comments below. Is the German economy doomed? And is there anything they can do to turn things around? Let me know in the comments below. Stay safe, guys. Be sure to smash the like button and subscribe as we navigate through these crazy times.